welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I'm going to go through my portfolio and then I will answer some questions which I have received from the audience. So let's start by looking closer at the portfolio. So the first thing we notice is that there was a red circle for this week's episode, meaning that the portfolio is down in value compared to last week. So if we go to the portfolio values tab here, we can see that I have lost $1,000 compared to last week, or rather the portfolio is down $1,000 compared to last week because I have not sold anything, so I have not realized the loss yet. And some people might say, oh, $1,000, that's a lot of money. Sure, $1,000 is a lot of money, but this is very normal market fluctuations. And if we actually go back to March, then we could see that I had a week where I lost more than $10,000 within a single week, and that was at a point in time where the portfolio was much lower in value, or much smaller, you can say, so the loss was actually much more severe. It was a little less than 20% of the portfolio value that I lost within a single week. So why do I put so much emphasis on whether the portfolio is down in value or if I have actually lost the money? Well, if you look at the graph here, my portfolio was severely down in value back in March. If I were to realize those losses, then I would have realized a loss of more than 50%. But what happened in my portfolio, since I have stayed consistent and kept on investing even though the market has been severely down, well, you can very clearly see here that the portfolio, slowly but surely, and actually much faster than I expected, is increasing in value again. So now I'm only down around 8% compared to around 50% which I were back in March. And I know, of course, that this graph is cheating a little bit because here you cannot see what the cost of the portfolio has been. You can simply just see the dollar amount that the portfolio is worth. That is why I keep mentioning how much I'm actually still down percentage-wise in the portfolio. Because if I just keep on adding money, then surely this graph will always keep increasing if I just add enough. And surely I have a goal of increasing this portfolio value, because if I increase it sufficiently, then the passive income that the portfolio will create will at some point be enough for me to live from. How much I would need for that really depends on what kind of lifestyle that I want to have once you are able to retire, or simply reaching financial independence. So next year, one obvious goal would be to say, oh, I need to reach this $100,000 barrier. Well, the $100,000 barrier is not necessarily something that I can determine myself, because I'm relying on that the stocks are not losing value. So if we get a new pandemic or we get a setback, then my portfolio will take a severe hit yet again. And then it doesn't matter how much I can invest, because if I lose 50% of the portfolio value, I will not be able to invest $50,000 more next year. So surely it will be nice to hit a six-figure portfolio, but what I actually focus more on is the dividends. So if we go and take a closer look at the dividends tab here, we can see that I have received a little more than $10 in dividends for this week. So currently I have received $62 this month so far, and we can see that Q4 is starting to catch up on Q3, since I have received $432 so far in Q4, and I received $466 back in Q3. So an obvious goal for me to have next year is, for instance, trying to see if I can increase the yearly dividend income to around $3,000. So if I'm capable of adding a sufficient amount of money to increase the dividend amounts that I'm going to receive, that is something that I feel I can control a little more, since the dividends tends to fluctuate less than the stock prices. Of course, I'm still relying on the companies to keep paying out those dividends, and not seeing what we have seen with Disney this year, where they have slashed it completely. You can also simply just look at the companies in the portfolio. I mean, I have a stock where I'm still down more than 50%, and now I have a stock where I'm up more than 30%. So I mean, I'm not trying to predict what a stock will do a month from now, a week from now, 2 months from now. The stocks that I'm buying is because I believe that in 5 or 10 or 20 years from now, they will be worth more than they are today, and that they will increase their dividends in the meantime. So that is what I'm doing in this portfolio, and that is why I think that at some point I will be capable of living off those dividends. And as I mentioned earlier, we will of course from time to time see cases like Disney where they have slashed the dividend completely. But what you notice here is, despite the fact that I bought this stock back in January and February, where it was actually quite high in value compared to what it was in March, now I'm actually up close to 30% within a single year. And I mean, I could have bought this stock at $85 in March, so you could have been up 100%. But despite the fact that I mistimed the market completely with this one, I'm still up 30% year to date, which is remarkable. So I don't mind that some of the companies slashes their dividends from time to time, because as I have mentioned with Disney previously, currently I think that the company has a better use of the capital than paying it out on dividends, because what we're seeing with Disney is they are exploding in their streaming service. I mean, how can the stock be up 30% compared to January? I mean, no one is going to Disney World, no one is going on the cruise lines with Disney. So a lot of the business is actually struggling, but the Disney Plus service, I mean, they have more than 80 million people subscribing to that. So are other investors looking to Disney and think, oh, this will be the next Netflix, which will be 20 times worth its value within 10 years? Perhaps. On the contrary, you could of course also look at a company like Carnival Corporation in my portfolio. But I mean, look at what business they're operating in. Cruise line industry, of course they are struggling severely with this current pandemic going on. No one is going on cruise lines currently. I mean, when your company is associated with being a human petri dish, that's not really an appealing brand to have. But if they survive this, I mean, of course they had to sell some of their ships currently because they are seriously struggling, but how many cruise line companies will survive this? Of course, all their competitors are also suffering a lot. So currently I personally think that I'm willing to take the risk that they're not going bankrupt, and I believe 10 years from now that the stock will be worth more than it is today. So that is why I have not realized a loss of 50%. But there's no guarantee. I mean, I could be absolutely wrong, and then I would have lost all the money that I have invested in that company. And that is my reason for why I own a lot of different companies, so I can actually afford to be wrong from time to time. And this is where it becomes so important to talk about margin of safety, as both Benjamin Graham and Warren Buffett mentions from time to time. I mean, if you think that the company is worth $20, then you shouldn't buy it at $20. Then you should, for instance, apply a margin of safety of, let's say, 20%. Then if you think the company is worth $20, then you should only buy it if it goes below $16. And as a rule of thumb, the more insecure you are about the value of the business, the higher the margin of safety you should apply. So for instance, when I bought Unum Group, I mean, I bought it at below $20 because I thought it was worth at least $25 when I bought it. And currently that has played out quite nicely. And there is of course no guarantee, because you could also take a look at Wells Fargo when I bought them, and I thought they were worth much more than they are today. So from time to time you will be wrong, you simply just have to accept that fact. And to continue with some more company specific related news, Disney Plus are going to increase the price of $1 as of 22nd of March next year. They will increase the price from $7 to $8, unless of course you decide to sign up for a full year, then you will pay $80 instead of $8 per month. And at the same time, they are bumping up their projections for how many subscribers they will have by 2024. they estimate that they will have between 230 and 260 million subscribers, since they have already reached their 2024 numbers, which they have previously predicted, since they now have more than 86 million subscribers. And this was very well received by the market, because as we can see here, Disney actually increased the stock price by more than 13% as of Friday. So the investors were really happy to see these new estimates and the bump in price, because this means that they're going to earn more money. And to continue with some more dividend related news, AT&T has declared a dividend which is in line with previous, meaning that you will still receive 52 cents for every share that you hold in AT&T, with ex-dividend January 8th and payable February 1st. And if we continue, we can see that JP Morgan has also declared a dividend which is in line with previous. And finally, we have Realty Income Corp, who has bumped the dividend just slightly with 0.2%. So now, instead of receiving $0.234 per share in Realty Income Corp, now you're going to receive $0.2345 instead. If we then continue with questions from the audience, then I have received a question from one of my Danish viewers who simply asked, what do I feel about this article, and especially about the analysis in the article. So I will of course share a link in the description below. Unfortunately, the article is from a Danish newspaper, so the article is in Danish, but I will try and recap it here and try and answer the question. So the headline for this article reads, Rohde and Wammen is delivering misplaced optimism, and Berlingske is making a do-it-yourself and are seeing clouded grey skies for 2021. So Lars Rohde is the chairman of the central bank and Rohde Wammen is the Minister of Finance in Denmark. So a short summary for this article is that the chairman of the central bank and our Minister of Finance are apparently too optimistic for the outlook of the Danish economy for 2021, according to the journalist who has written this article. And the journalist here is a former chief economist of one of the big financial institutions in Denmark called Nykredit. And basically he says that they have not updated the input to their models, since they are relying on data from August instead of actually updating their data from October or November, since we have now been hit by the second and the third wave of this pandemic. And the major argument that the journalist is presenting in this article is that the Danish economy has not been hit as hard as previously predicted by the central bank this year, and hence the rebound next year will not be as big as they are currently predicting. Hence the title of this article, that he thinks that they are too optimistic. So what do I actually think about this article? Well, I will refer back to episode 12, Always Wrong but Sometimes Useful, because here I looked closer at the central bank's economic outlook for 2020, and at that point in time they clearly stated here that it was not possible at this stage to estimate precisely what the impact of the pandemic to the economy was using traditional macroeconomic models. So I think it's very fair to say that there is a lot of uncertainty here. So of course the journalist has some right to claim that perhaps they are too optimistic if they have actually overestimated the severity of the pandemic, but I still think that you need to give them some good faith here and say, well, they are simply trying to do the best they can with the data that they have at hand. So I don't really feel strongly for either or. I would simply say, well, what should I use this news for? Well, I should certainly know that we are facing a situation with a lot of uncertainty, and then I should try to act accordingly to that. And the reason why I don't feel too strong about either or in this situation is that I'm trying to remind myself of the words from Benjamin Graham and Warren Buffett, that I should focus my time and energy on the specific companies that I want to invest in, because that will matter much more than how the global macroeconomic situation will develop. Of course, I should take it into consideration, but my time will probably be spent much better actually studying the economic results of the companies that I'm potentially wanting to invest in, or the companies that I have already invested in and should potentially sell out of. So that is why I keep showing the companies which I have invested in and try to cover some of the news regarding those companies. And I keep mentioning, just because I have bought a company, then you shouldn't buy it. Always remember to do your own due diligence, because if you have bought a company just because I have bought it, then you will most likely sell out of that company if it drops 50% or more in value, like we saw back in March. And if you are tempted to do so because you feel that you didn't know what you were doing, there is no shame in that, but then you are probably better off buying index funds instead of trying to pick individual companies. If you are not capable of making an informed decision and think that you have some knowledge about what you are doing, then you should simply acknowledge that for yourself and say, well, before I start investing in individual companies, perhaps I should learn a bit more and start with investing in index funds and simply saying, instead of searching for the needle in the haystack, I will simply just buy the haystack. Just to quote Jack Bogle, who is the author of the Little Book of Common Sense Investing, which is a book that I could highly recommend that you read, and he is also the founder of Vanguard Investment Funds. So that actually concludes yet another exciting week of the Lazy Money Game. So perhaps you would like to put your predictions in the comments about when you think I will be back in positive territory for my portfolio. Will it be a month? Will it be half a year? Or will it take 5 years? Put your guess down below, and then we will see who is right in some years' time, or perhaps in a couple of months. Who knows? If you like content like this, then please consider giving a like, leaving a comment, or give me a subscription. And until I see you next Sunday, bye!